Hi friends, this is Sanjay Pandita from Success Academy. Today we discuss about large cap, mid cap and small cap with its features and best strategies in details. Please watch the video till end to understand it completely. In the world of stock investing, there are various ways to categorize companies based on their market capitalization. Market capitalization or market cap is the total value of a company's outstanding shares of stock, calculated by multiplying the current stock price by the total number of outstanding shares. Based on market cap, companies can be classified into three categories: large cap, mid cap, and small cap. Large cap companies are typically those with market capitalization over $10 billion. They are well-established, well-known companies that have been around for a while and are typically leaders in their industry. They have a large market share, and their products and services are widely recognized. Some examples of large cap companies include Apple, Microsoft, Amazon, and Facebook. Features of large cap companies. 1. Market leadership. Large cap companies are market leaders in their respective industries. 1. They have a significant share of the market, and their products and services are widely recognized. 2. Stable and mature. Large cap companies are usually well established and have a proven track record of generating consistent revenue and profits. 3. Low volatility. Large cap stocks are considered to be less volatile than mid and small cap stocks. 3. They are less susceptible to market fluctuations and economic downturns. 4. Dividends. Large cap companies often pay dividends to their shareholders as they generate significant cash flows and have more predictable earnings. Strategies for investing in large cap companies. 1. Growth investing. Investors can invest in large cap companies that have the potential to grow their revenue and profits over time. 1. They typically have a strong competitive advantage, innovative products, and services. 2. Value investing. Investors can look for large cap companies that are undervalued based on their earnings, cash flow, or book value. 2. These companies may have temporarily fallen out of favor with the market, but they have strong fundamentals and potential for long-term growth. 3. Income investing. Investors can focus on large cap companies that pay dividends to their shareholders. 3. These companies typically have a stable business model, predictable cash flows, and a history of consistent dividend payments. Mid-cap companies. Mid-cap companies have market capitalization between $2 billion and $10 billion. They are typically companies that have been around for a while but are not yet considered large cap. Mid-cap companies may be well established, but they may still have room for growth and expansion. Some examples of mid-cap companies include Dropbox, Etsy, and Under Armour. Features of mid-cap companies. 1. Growth potential. Mid-cap companies have the potential to grow their revenue and profits over time as they continue to expand their operations and customer base. 2. Higher volatility. Mid-cap stocks are more volatile than large-cap stocks but less volatile than small-cap stocks. 2. They are more susceptible to market fluctuations and economic downturns. 3. Dividends. Mid-cap companies may or may not pay dividends. 3. If they do, the dividend yield may be lower than that of large-cap companies. 4. Niche markets. Mid-cap companies may operate in niche markets, where they have a competitive advantage over larger companies. Strategies for investing in mid-cap companies. 1. Growth investing. Investors can invest in mid-cap companies that have the potential to grow their revenue and profits over time. 1. These companies may have a competitive advantage, innovative products, and services, and may be expanding into new markets. 2. Value investing. Investors can look for mid-cap companies that are undervalued based on their earnings, cash flow, or book value. 2. These companies may be temporarily out of favor with the market, but they have strong fundamentals and potential for long-term growth. 3. Momentum investing. Investors can focus on mid-cap companies that are showing strong momentum in terms of their revenue, earnings, or stock price. Small cap companies. Small cap companies have market capitalization between $300 million and $2 billion. They are typically younger companies that are still in the growth phase, and their products and services may not be as well known as those of large cap companies. Some examples of small cap companies include Crocs, Dropbox, and Etsy. Features of small cap companies. 1. Growth potential. Small cap companies have a high potential for growth as they are still in the early stages of their development. 1. They may be expanding into new markets or developing new products and services. 2. High volatility. Small cap stocks are more volatile than large and mid cap stocks. 2. They are more susceptible to market fluctuations and economic downturns, and their stock prices can fluctuate significantly over short periods. 3. Risky investments. Small cap companies are considered to be riskier investments than large cap and mid cap companies as they may have limited resources and a higher risk of failure. 4. Little to no dividends. Small cap companies typically do not pay dividends as they reinvest their profits back into the business to fuel growth. Strategies for investing in small cap companies. 1. Growth investing. Investors can invest in small cap companies that have the potential to grow rapidly over time. 1. These companies may be expanding into new markets or developing innovative products and services. 2. Value investing. Investors can look for small cap companies that are undervalued based on their earnings, cash flow, or book value. 2. These companies may be temporarily out of favor with the market but have strong fundamentals and potential for long-term growth. 3. Emerging market investing. Small cap companies may operate in emerging markets where there is significant potential for growth. 3. Investors can take advantage of these opportunities by investing in small cap companies that operate in these markets. 4. Risk management. Investing in small cap companies can be risky, and investors should consider diversifying their portfolio to mitigate the risk. 4. They can also consider investing in small cap mutual funds or exchange traded funds, ETFs, that provide exposure to a diversified portfolio of small cap stocks. In conclusion, understanding the differences between large cap, mid cap, and small cap companies is essential for investors as it can help them determine their investment strategies based on their risk tolerance, investment objectives, and time horizon. Large cap companies are well established and have a track record of generating consistent revenue and profits. Mid cap companies have room for growth and expansion and may operate in niche markets. Small cap companies are still in the growth phase and have a high potential for growth, but they are also riskier investments. Investors can choose to invest in these companies based on their investment goals and risk tolerance. If you like this video, please like, share, subscribe the video and please don't forget to press bell icon. It motivates us to make informative videos for you. If you want to learn about share market and its trading strategies online live video classes, please drop your mail at info@successacademy.in or WhatsApp at +91 97972566675.